Welcome back. So, in the last lecture I introduced the concept of option Greeks. These option Greeks as I mentioned were represent sensitivities of the price of the call or put or for that matter any derivative position with respect to certain factors which influence the value of such positions. We identified certain factors, we identified obviously the price of the underlying as the fundamental factor, the most important factor. Then we had the risk free asset, we had the stock yield if there is any, we had term to maturity, the remaining term to maturity or the term elapsed in that case, which are interrelated, and of course, the volatility of the underlying asset. So, these are certain factors which influence the price of the derivative position, and by option Greeks we mean the sensitivity or the partial derivatives in mathematical terminology of the price of the or the value of the derivatives position with respect to each of these factors. Then I discussed the Taylor expansion in terms of these option Greeks. We will not go into that again. Then we discussed the first and perhaps the most important option Greek, which is delta. Delta represents the change in the price of the portfolio, change in price of the call option for as epitomizing the portfolio, we shall be using that. So, change in price of the call option with respect to the change in price of the underlying. As you can see from this diagram, the change in price of the derivative position of the call option has a certain curvature, that is very important, and the slope therefore changes from point to point, and the slope at a given point gives the value of delta or gives the value of the sensitivity at that particular point. In fact, the curvature is captured by the second derivative, which is also a very important option Greek and is given the name gamma. We shall be talking about it. Now, we have earlier derived in the case of the Black-Scholes model, the value of delta is given by phi of d 1, where d 1 is this expression. And as you can see, as the stock price increases, the log this term will increase, and because this term will increase and because phi represents the cumulative normal distribution, standard normal distribution. So, as d 1 increases, phi d 1 will also increase, and therefore, the inference is that as the stock price increases, the value of d 1 and therefore, the value of phi d 1 and therefore, the value of delta also increases. You can see from here the value of delta of out of the money options is close to 0, and the value of delta of in the money options is close to 1. And the delta for call options ranges from 0 to 1, delta put option ranges from -1 to 0, and delta of out of the money options is pretty close to 0, delta of out of the money of in the money options is pretty close to 1. As a general rule, of course, in the money options will move more than out of the money options, because their delta is higher. So, naturally, their sensitivity to the price of the underlying is also higher. We have given a mathematical interpretation or mathematical justification why the delta of in the money options is close to 1 and why delta of out of the money options is close to 0. You see, in terms of the financial aspect, you would recall that the payoff of a call option at maturity is given by S t minus k. So, the more the option is in the money, the more the option is in the money, the more is the probability of recovering this payoff S t minus k, and therefore, because k is constant, and therefore, as the stock price increases, this payoff is likely to increase, and this would be reflected in the price of the option as well. Conversely, if the option is well out of the money, then the probability of exercising of the option becomes very small, and therefore, the realizing of this payoff is very small, and therefore, small changes in the price of the underlying asset are not going to significantly affect this probability of realizing this payoff. And because this payoff is unlikely to be realized, whether the stock price changes by a small minute amount, by a small amount, the option price is also not likely to change significantly, is not likely to mimic the price of the change in price of the underlying asset, and therefore, delta of out of the money options would be close to 0. Delta and expiration, as you can see, there is from this mathematical derivation, the implication of which is basically the taking of the derivative of delta with respect to time to expiration, and then working out with respect to the elapsed time. What do we find? We find that if s tends to infinity, that the option is deep in the money, then the delta with respect to as the expiration approaches, delta changes very rapidly towards its value of 1 for in the money options. And if the options are well out of the money, again we have a similar situation, but diametrically opposite, in the sense that delta again changes very rapidly, but then it decreases and moves very rapidly to the value 0. As you can see, what I have just mentioned is depicted in this diagram. Please note, because we are moving closer to expiration, therefore, we need to interpret this diagram while moving towards the left hand side. Expiration would be represented towards the left hand side. The time to expiration is being reduced. And as you can see, when the time to expiration is very small, delta is moving very rapidly towards 1 for in the money options, and delta is moving very rapidly towards 0 for out of the money options, this portion and this portion respectively. At the money options show a relatively anomalous behavior, but the basic thing is that short term options react very significantly to changes in stock price compared to long term options. As you can see here, long term option movements are much less sensitive to changes in price or changes in the time to expiration compared to when the options are very close to maturity. And there is a logic for this. The logic is that the time value of the option gets eroded very fast as you move towards expiration, and that is why the change in price is very rapid when you move towards expiration. Put call parity, we have talked about the sum of the absolute values of the delta for the call option and the delta for the put option is equal to 1. Delta hedging we have already encountered in the context of the Black-Scholes model. We constructed a portfolio consisting of either a long position or a short position in one unit of the derivative, and we neutralized the price change of the derivative by taking delta units of the underlying asset, and then we said that this portfolio has no term that depends on the Brownian motion, or depends on the fluctuations of the prices, and therefore, it will generate a risk free asset. But the important thing was that we emphasized at that point also, and we emphasized once again that risklessness of the portfolio was confined to a very small interval of time dt, infinitesimal in time interval dt. If the why was that? The reason was that contained a term del c by del s, and we assumed that del c by del s was constant over the interval dt. However, this actually does not remain constant. In fact, with every stock move, the value of delta and in fact, this quantity, which is nothing but delta, changes because of the curvature. As the stock price changes, the curvature changes, and therefore, the slope changes, and this slope is captured by gamma. But the basic thing is that because delta changes, the portfolio which was delta neutral at one point on the curve would not remain neutral at another point on the curve. Therefore, the risklessness of the portfolio would be confined to a very small change in stock price. If the stock price is anywhere near significant, it would result in an imbalancing of the riskless portfolio, and therefore, there would be a change in the overall price of the portfolio, combined portfolio of the call option and the underlying asset. and therefore as a corollary thereto, we will need to rebalance our portfolio very frequently, in fact on a continuous basis, if we were to achieve delta neutrality over a substantial period of stock price movements. But this frequency of rebalancing really depends on how rapidly the delta changes, which is again captured by another option Greek, which is called the gamma. If the gamma is small, that means the change in slope is small, and if the change in slope is small, the riskless portfolio that you have constructed at any one point on the curve would be riskless over a significant price movement, because the delta would not change much. And if the gamma was large, that means the convexity or the slope would be large, and if the slope is large, then naturally delta would change significantly, and if delta changes significantly, the need for rebalancing would be more. So, portfolios that have a small gamma are more robust and they do not require frequent rebalancing. Right. So, let us summarize quickly what we have talked about. Positions with positive delta increase in value as the underlying price goes up. Positions with negative delta increase in value if the underlying price goes down. This is quantitatively shown if you ignore the other terms. DC is the change in price of the call option is equal to delta into ds. Delta is the first derivative. So, truncating the Taylor series to first term, this is nothing but dc is equal to delta into ds. If delta is positive, then dc would be positive if ds is positive, and dc would be negative if ds is negative. So, positive delta, positive in ds gives you a positive value for dc. In other words, if you have a positive delta portfolio and the stock price increases, the value of your portfolio increases, and vice versa. Call delta increases with increases in stock price. We mentioned the stock price, the delta ranges from 0 to 1 as the stock price increases. Options gradually move from out of the money to in the money, and delta moves from 0 to 1. And as expiration approaches, the delta for the in the money call approaches 1 rapidly, delta for out of the money call approaches 0 rapidly. Now, delta hedging provides immunity against price changes. Delta hedging means you have a risk delta neutral portfolio. If a portfolio has a delta of 0, then it is hedged against price changes, but over an infinitesimal interval, as I just now mentioned. Now, we come to the next option Greek. The next option Greek, as I have mentioned while talking about delta, is gamma. Gamma is nothing but the first derivative of delta with respect to the stock price. In other words, the second derivative of the call option, second derivative of my derivative portfolio with respect to the call price, with respect to the stock price, sorry, with respect to the stock price. So, it really measures the rate of change of the slope, how much curvature is there in the price of the portfolio that is captured by this expression gamma. If gamma is small, that means the price curve of the portfolio is relatively flat, and if gamma is large, the curvature is significant. So, it is the rate of change of delta, it is the second derivative of the price of the portfolio with the price of the call option of the portfolio with respect to the stock price. And gamma is also again changing with respect to the stock price. As stock price changes, gamma also changes. As you can see, this is my slope at this point. Let us call it point A, and then this, suppose I construct a tangent here. This is my slope at point B. Therefore, you can see the slope has changed. The slope here is given by this quantity, and the slope here would be given by something like, if I draw this, the slope B would be this quantity, and the slope at A would be given by theta, the slope at B would be given by phi, and so the slope obviously has changed, and the rate of change of the slope is captured by gamma. Now, this gamma is basically a measure of the hedging error, as you can see here. You see, suppose I had constructed a delta neutral portfolio at the point A, and at this point A, the stock price was S, Now, there has been a positive movement in the stock price. The stock price has moved from S to S dash. Now, because the stock price has moved from S to S dash, and the price of the call option has moved from C to C double dash. The price of the call option has moved from C to C double dash, this point. When the stock price has moved from S to S dash, I repeat, the stock price has moved from S to S dash, the call option price has moved from C to C double dash. However, what about the price of the stock? The stock price has moved from S to S dash, and because I have delta units of the stock, the stock component of the portfolio would have changed in value to this point. Because the portfolio consists of not one unit of this stock, but delta units of this stock. Delta units of the stock would have changed in value, that is the second component, the stock component of the portfolio would have changed. Here we had a delta neutral portfolio. Now, delta units of the stock, because one unit of the stock has changed from S to S dash, therefore, delta units of the stock would have changed from delta into S minus S dash minus S, which is given by this point. So, as you can see, while the call has moved in value from C to C dash, only the portion from the call has moved in value from C to C double dash. The call has moved in value from C to C double dash. The stock component has only moved from C to C dash. In other words, because the stock position is opposite to the call position, only the portion C to C dash of C to C double dash is neutralized by the stock price. Let me repeat. You see, there has been a change in the stock price from S to S dash. Now, because of the change in stock price from S to S dash, the call price has moved from C to C double dash. This is point C double dash is the point along the curve which represents the call price as a function of S t. Now, let us look at what happens to the stock component, because we are having two components in the portfolio, the call component and the stock component. The stock component would have moved linearly with this expression S dash minus S, but we have delta units of the stock. So, the stock component would have moved from this point to this point. This is the change represented in delta units of the stock, not one unit. One unit is so much, delta units is so much. Therefore, because the two positions are opposite, this portion of this total movement, this is the total movement, this portion is the stock movement, this portion of the total movement is cancelled by the stock, but this portion, this particular portion, the portion between C dash and C double dash does not get annulled by the change in the stock price, and this represents the hedging error. And where has this come from? This has come due to the curvature of the call price. If the call price has no curvature, then this curve would have aligned with this green line, and the hedging would have been perfect. But because the call price has a curvature, delta also changes from point to point, and therefore, because of this change in delta, the hedging is not perfect, and there is a difference between the amount that we have neutralized and the amount of change in the price of the call option. And C dash minus C dash C double dash minus C dash, I am sorry, C double dash minus C dash represents the hedging error, and this is measured by gamma, measured by the curvature of the price of the call option. So, this is the expression for gamma, quite straightforward. It is the first derivative of delta or the second derivative of the call price. For the Black-Scholes formula, this is the expression that we get from deriving. That derivation is shown in the end of this presentation, but this is what it is. And one more thing, you can see from here, it is clear that gamma will either be greater than 0, but with approaching 0 in the limiting case. What are those limiting cases? The limiting cases are if the stock price tends to infinity, then again gamma approaches 0, and if stock price tends to 0, gamma again approaches 0, and within this particular portion, as the option remains at the money, gamma gets its maximum positive value. Remember, long positions in the call options always carry a positive gamma. In fact, long positions in put options also have a positive gamma. In the Black-Scholes model, the gamma of the call option and the gamma of the put option are equal. So, as gamma becomes, see, and the justification for this behavior, as gamma becomes more in the money, they more and more reflect the stock price, they mimic the stock price, and therefore, because they mimic the stock price, the change in the delta is insignificant, and because the change in the delta is insignificant, therefore, gamma tends to 0, and a similar scenario occurs when we have the call moving out of the money. As the call moves out of the money, you get pretty sure of the payoff, which is in fact 0 in this case, and therefore, the change in delta becomes negligible, the change in price becomes negligible, the change in delta becomes negligible, and therefore, gamma also becomes negligible. And gamma has a peak value around the exercise price, more or less close to the exercise price, that is when the options are at the money. And gamma and expiration, this is interesting. Now, as you can see, out of the money options, as I mentioned, tend to have very low gammas. In the money options also have tend to have very low gammas, and as expiration approaches, because the nature of the payoff becomes more and more clear, more and more explicit, the moneyness of the option becomes more and more certain in a sense. Therefore, gamma also tends to decrease and approaches 0 as expiration approaches. As you can see, both out of the money and in the money options, their gamma approaches 0 as we approach expiration. But look at what happens to the at the money options, gamma of at the money options. Now, as you approach expiration, gamma of at the money options increases very rapidly, very significantly as we approach expiration of the at the money option. So, in summary, gamma of in the money option approaches 0, gamma out of the money option approaches 0 as expiration approaches, but gamma at the money option becomes large and significant and positive as expiration approaches. So, what does it mean? There is an interesting implication of this, because gamma is large and positive as expiration approaches for at the money options. If you are taking a position in at the money options, short term options, that means the options are pretty close to expiration, and you are taking a long position in at the money options, that means you are creating a significantly large gamma. If you are creating a significantly large gamma, that means your position is susceptible, or your position would change in value significantly if there is a change in stock price, if there is a significant change in stock price. Therefore, you are more sensitive to the change in stock price. But the important thing is, if you have a positive gamma, the gamma operates in favor of you, for favor of the investor, and if you have a negative gamma, the gamma tends to operate against you. So, short term at the money options, although they carry large risk, they tend to be favorable to the investor. What is the counter side of it? I will come to it when I discuss the next option Greek, which is theta. However, as I mentioned, in the money and at the money options, gamma approaches 0. As you can see also in this diagram, this is the 9 month, this is the 6 month blue one, and the black one is the 3 month one. So, this is the closest to expiration, and this is having the highest gamma, as we have discussed just now, and it is having the highest gamma towards the exercise price. Therefore, it is at the money. So, at the money options tends to have highest gamma, and as you can see, even in this case, as the stock price moves away from the exercise price, the gamma tends to fall. In fact, that is true for all the 3 cases, as you can see in this diagram. effect of volatility on gamma, this is very interesting. If the volatility is low, then at the money options have a high gamma. If volatility is low, at the money options have a high gamma, but in the money and out of the money options have low gammas. Why is that? You see, at the money options have significant time value, and as with increase in volatility, you see, if the volatility increases, if the volatility, let us start with the volatility being low. If the volatility is low, then an option which is in the money or an option which is out of the money, option which is out of the money, option which is in the money, they are likely to remain more or less at the same level at expiration. Why? Because the stock price is not moving significantly. Why? Because the volatility is low, or you can say it is the other way around, because the stock price is not moving significantly, the volatility is low, and because the stock price is not moving significantly, there is little chance of an in the money option bouncing at the money and or out of the money bouncing bouncing at the money. In other words, the moneyness is more or less determined, more or less crystallized, and that being the case, if the moneyness is more or less crystallized, the time value factor is not significant, and if the time value factor of the option is not significant, naturally for the in the money and out of the money options, time value factor is not significant, because they are not going to jump at the money from above or from the below. Remember, time value is most for at the money options. So, if the option is in the money or out of the money and the volatility is low, so it is unlikely that it would jump into at the money, and therefore, gamma for these two situations would be less if the volatility is low. However, if the volatility is high, then what happens? If the stock price is showing significant fluctuations, then there is definitely a chance that an option which is out of the money could jump back at the money, or an option which is presently in the money could jump back at the money, and if that is so, then gamma is more or less the same across the entire spectrum of moneyness. So, that is the basic difference, that is the basic impact of volatility. Volatility in the case of, if the volatility is low, then in the money and out of the money options tend to remain a scenario and remain in the same scenario, and because volatility of at the money at the money options have significant time value, and therefore, even if volatility is low, they will have a significant impact on the gamma. But if volatility is high, then in the money, at the money and out of the money, all of them are influenced by the volatility, and in that scenario the impact is more equally distributed. So, that is the logic. So, if the volatility is high, time value of all the options is quite significant. They can jump out of the money, can jump into at the money, in the money can jump into at the money can jump into in the money and out of the money, and so on. So, all combinations. So that is why the time value is more or less reasonably distributed. So, in high volatility, the what happens is gamma tends to be stable across the strike prices. However, if volatility is low, only the at the money options are significantly affected by volatility, the other are not. Now, as I mentioned while talking about delta hedging, the role of gamma in hedging is significant. It determines the flatness of the call price curve, and because it determines the flatness of the call price curve, it determines the relative frequency at which rebalancing is called for. If the gamma is small, rebalancing can be taken place at longer intervals, longer periodic intervals, whereas if gamma is large, the curvature is high, then you have to do rebalancing at very short intervals, because delta is going to change very quickly, and because delta changes very quickly with respect to the stock price, the delta neutral portfolio very quickly goes out of neutrality. So, it has to be rebalanced. Now, how to create a delta gamma neutral portfolio, that is very interesting. We will take it after the break. Thank you.